Ladies and gentlemen, good day and welcome to the Niva Bupa Health Insurance Company Limited Q2 FY26 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anshuman Deb from ICICI Securities Limited. Thank you, and over to you, sir.
Good evening, ladies and gentlemen. It's a privilege to host the management team of Niva Bupa Health Insurance Company Limited for their Q2 FY26 results conference call. From the management, we have Mr. Krishnan Ramachandran, MD and CEO, Mr. Vishwanath Mahendra, ED and CFO, Mr. Ankur Kharbanda, ED and Chief Business Officer, Mr. Bhavatosh Mishra, Chief Operating Officer, Mr. Dhiresh Rastogi, Chief Technology Officer, and Mr. Vikas Jain, Chief Investment Officer. Without further ado, I will now hand over the call to Mr. Krishnan Ramachandran, MD and CEO. Over to you, sir.
Thank you, Anshuman, and thank you to everyone of you listening in on this call for the time late evening today. H1 for us was a productive and eventful quarter. Given the accounting changes that happened in the second half of last financial year, to make sure that we are able to assess or review our results on a like-to-like basis, for most part, I will focus on our IFRS financials or, without 1/n numbers specifically when it comes to things like growth rate. So in summary, for H1, we achieved an overall growth rate of 23% and a retail growth rate of 28% without 1/n. Our IFRS PAT for H1 improved to 132 crores, up from 60 crores similar period last year. And our combined insurance service ratio for H1 improved by more than 100 basis points to 103.1%, down from 104.2% last year. And our retail market share, which is basis reported numbers, to that extent have noise because of 1/n accounting change, held steady at 9.9%. We continue to trend very well on a range of customer metrics. Our settlement ratio for Q2 on claims was 95.2%. And our weighted average NPS, to remind all of you, we measure this across 35 critical customer touch points, improved to 57 for H1. We continue to sell the right sum insured and products to our customers as evidenced by our industry-leading ATS at more than 31,000 rupees. And also, close to 83% of our policies have a sum insured or have of 1 million or above. In Q2, we also launched what we believe is the next generation retail health insurance product, Reassure 3.0. It is found very good reception and is doing very well in the marketplace as we speak. We also made good progress on our health ecosystem, or as Bupa calls it, a wider strategy. With in H1 more than 13 million downloads, we have 5.8 monthly active users on the customer app, and more than 51,000 health checkups every month, and about 6,700 doctor consults every month using our customer app. Our product and distribution mix has been largely stable. We added one more city in our provider network, which is our strategy to manage a great customer experience and claims cost at the same time. And about 17% of our claims in the cities where our PPN is present, go through these PPN hospitals. We've also seen incidence rates and average claim size range bound and within what we call a stable trend. And also consequently, our retail health claims ratio H1 to H1 this year to last year is more or less flat. So broadly, that's been a summary of our performance. And I do, before I hand over to Vishwanath, I will touch upon a topic that I understand is, fired up our collective imagination, if you will, which is this whole topic of GST. And I really want all of us to step back and look at this change for what it really is, in my opinion. The first part is GST has come down from 18% to 0%. And I'll quote what the Chairman IRDA has stated, which is that food is at 0% GST. So at the highest level of policy making, health insurance has been recognized as being equivalent to food in terms of how essential it is in the arsenal of financial services products that a customer should have. So I think this is an incredible win for the industry. Having personally been involved year after year in lobbying for GST coming down, so I think 0% GST is an incredible step from the highest level of policymakers in our country. Second is, we should look at it beyond, maybe this quarter or next quarter for what it really is, which is that it is a drop in price. And survey after survey on health insurance has suggested that affordability is a barrier to purchase of health insurance, which is to say that this is a category where price elasticity, demand, does see a price elasticity curve as in many other categories. So to that extent, this should be a significant fillip to demand for the category. And indeed, as many of my friends in the industry have already commented, we, like many others, are seeing demand go up. As a case in point, October, in spite of being a Diwali month, which is historically a low season for health insurance, we have seen very, very good uptick in demand. But I'm sure my colleague Ankur can talk more about that. Now, on the topic of ITC, what I can say is that today is when we process commissions. We have passed on commissions, but I think using the term passed on commissions is not reflective of our philosophy of what this change means for every stakeholder. We truly feel, or we truly believe, it's a win for customers through lower price. We believe it's a win. We believe and we will make this a win for our distribution. And we're confident that whatever income loss there is will be more than made up through increased volumes. And also, one of the other problem statements for a category is there is significant underinsurance. So the 18% fall in price, we should think about it in terms of what can we do to give customers more adequate insurance, both at the time of acquiring new customers as well as renewal. And all of these measures, we truly believe will make it a win for our distribution as well, in spite of ITC being passed on. And in closing, before I hand over to Vishwanath, I mentioned this last time as well. There's been a lot of change in the last 12, 18 months, and change, necessarily has meant that all of our minds have been focused on the change. But I think now is the time for us to also step back and look at health insurance for what it truly is, which, in our opinion, it is one of the few secular, multi-decadal growth opportunities in our country. As I stated last time, we are very, very excited about this opportunity, and we are putting our investments where our mouth is, so to speak, right? So in distribution, for example, this year we have increased our headcount by more than 1,000 feet on street. We have set up an AI lab to explore many of the exciting capabilities that GenAI has to offer. And indeed, one of our customer projects got rated in the top 10 in the global ecosystem of Bupa. So this is something that we're very keenly invested in, focused on in terms of what it can do for our business, both from a sales, customer experience, as well as cost standpoint. And we've also gone live along with the launch of Reassure 3.0 with a modern microservices-based core system, which we believe will be transformational to us as we move along in terms of our ability to launch products and serve customers. So significant investments, we continue in making as a company to pursue the opportunity of health insurance. Growth with profit has been our mantra, and that's the journey that we've been progressing on. And this year is no different. Over to you, Vishwanath.
Thank you, sir. Good evening, everyone. So following some of the financial highlights for H1 FY26, GWP for H1 is rupees 3,983 crore, registering a growth rate of 23% over last financial year on like-to-like basis, which is without 1/n impact. The profit under tax, the profit after tax and the IFRS more than doubled from 60 crore in last financial year to 132 crore this financial year H1. Combined ratio for H1 FY26 and the IFRS has improved by 105 basis points to 103.1%. While there is increase in overall loss ratio by 1.2%, this has been more than offset by reduction in expense ratio by 2.3%, resulting in improvement of combined ratio. The retail loss ratio, which was slightly elevated in last quarter, has also moderated to last financial year level of H1. IFRS basis retail loss ratio for first half in current financial is 68.1%, which is in line with last financial year H1 loss ratio of 68%. There is year-on-year improvement in expense of management ratio to the tune of 3.7%, with H1 EOM being 36.3% as against last year of 40% same period. This is mainly on account of following factors. One is decrease in gross commission as a percentage of GWP due to change in mix, etc. But most importantly, because of operating leverage, where the expenses have gone up by low single digit, GWP has gone up by 23%. For first half, the allowable EOM ratio comes to 35.8%. So actually is above allowed by 50 basis points. We are confident of bringing down EOM ratio within regulatory limit in the current financial year as per the path submitted to the IRDAI. Annualized investment yield for H1 FY26 is 7.3% with AUM of rupees 8,482 crores. Solvency ratio is at a healthy level of 2.85x as on 30th September 2025. So this was an overview of H1 FY26. Happy to take questions.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and then one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, to register for a question, please press star and then one. Our first question comes from the line of Supratim Datta from Jefferies. Please go ahead.
Thanks for the opportunity. I have three questions. The first is on the October demand, and like you pointed out that the demand has been fairly strong. Wanted to understand, if you could break it down, what is driving this growth? Is it new products, new demand coming through, or is it existing customers taking higher sum assured, or is it greater rider attachment that is really driving growth here? So if you could break it down into what has been the key factor behind the stronger growth we are seeing in October, that would be very helpful. Secondly, on your comments around GST and the growth of settling any loss of commissions for distributors, while I do understand that, would you be taking a one-size-fits-all strategy here, or it would be more nuanced and depending on the type of distributor, would this strategy play out? That's one part of the question. The other is, how much of this impact would you be able to offset through a price hike? And given the GST has just taken place, would you be able to take a price hike in the next 6 to 8 months? That's the other question or we would like to understand. And lastly, on your retail health loss ratio, it has been stable, that's great. But insurers who have reported till now have shown an improvement actually versus last year to this year. And even if I look at on IFRS basis, quarter, second quarter versus second quarter last year, it's broadly flat. So wanted to understand, why is there a difference, or should we look at, you versus peers differently? So those are my three questions. Thank you.
Thank you very much. I'm Ankur Kharbanda. First, let me take the first two questions, which is on October performance and GST, and I will ask my colleagues to talk about the rest two on the pricing and the retail LR. First, on the October performance, very happy that one thing which we were pushing for on the GST side, lowering down the GST side from last few years, is now a reality. One is it has become a reality, and it has, for the month of October, which was a Diwali month, has given us substantial results. The numbers which are coming on the retail side are more than 50% growth, for the month of October, which clearly talks about that, this is really playing out well. It has, what it has done is, if I just give you numbers on the one of the platform which we look at is how are we doing on the queries coming on the Google side. That has gone up drastically. The conversion has also gone up drastically. So both in terms of queries and the conversions, both have gone up for us, and I'm assuming that's the case for the industry as well. The second thing which it has done is the per person buying in terms of the sum insured and the adequacy of the sum insured has also gone up. The proof for that is the ticket size. And for us, the ticket size for the month of October versus H1 is on the retail new business is plus 15%. That's the big difference which it has made. That's on the new business. But even on the renewal side, our ticket size has gone up. So one of the things which people are realizing is 18% lower GST means that there's a cushion of 18% for us to sell. We have gone up with our analytics model straight away from 1st October in terms of understanding which customer, payability, etc. And we have seen that there is a massive growth there as well on the renewal upsell, both in terms of sum insured and in terms of adding a rider. Both of them really, really worked well for us. And let me now get on to your second question on GST. As we know that GST exempt health citizens of India, everyone to get closer to our, universal health coverage as well. And to ensure that we give full, benefit to the customer, we have passed on the GST impact to the distributors. And our distributors have also understood this, that overall income will go up. And October has shown them as well that the overall income has gone up because the number of people buying insurance is going up, and the number of people also are taking a better cover there. So my point and the answer to it is we have done it for all, and distributors have also understood this. And just to relate a mutual fund industry in 2016-17 when this came in 7 years, mutual fund industry is 3 times of what they were earlier. Same thing happened, a cut, etc. happened. But the real thing was the customers were getting a better value. And this is also happening in our industry. When the customers are getting a better value, distributors understand that overall sales will go up, and which would mean that overall their income will go up as well. I would ask...
on the point on price revision, Supratim, given what we have seen and what Ankur said around volumes, we do not intend to take in a revision at least this quarter. We'll monitor how things are, and as needed to manage overall portfolio economics, we'll review it at the end of the quarter only, Anshuman. And on your question on loss ratio, I'll defer to Vishwanath to answer.
Yeah, so on loss ratio, for H1 we have seen same as last year, and last year was also kind of stable loss ratio. It was not too elevated. So it is at same level. Q1 it was higher, 2.5% to 3%. This year, this Q2 is lower. similar range. Trend perspective, yes, we are also seeing loss ratio on better in recent months. But for whole H1, it is at the same level.
Got it. Thank you.
Thank you. Our next question comes from the line of Varun Palacharla from Kotak Securities. Please go ahead.
My first question is again on the claims ratio part. So last quarter, if I remember correctly, we had provided a higher amount for claims which are outstanding, and as they run down, there should be some benefit coming in this quarter, right? If we include that benefit, how much is the claims ratio increased by in 2Q? That's one thing I wanted to ask. And second is with regard to the auto education system. Last time we had some disruption with regard to a IT supplier. So are we doing any changes on that front, or are we still continuing the same IT service provider?
So, in terms of IT service providers, we have taken assurance for infosec risk, etc., from third party, and after that only we have started with that. So we are very comfortable, and that was the reason it was outstanding was on a higher side. If you see whole H1, it is at same level. As I was mentioning, 2.5%. It was higher last quarter. The same is lower this quarter. Now, quantifying exactly how much is coming from last quarter versus this quarter, that's not something which I have handy. But broadly, for the H1, we are very comfortable. And the trend perspective also is comfortable downward trend.
The trend would be upward, right? Then if we include that impact, likely like 120 basis points, whatever up we are seeing in the first half basis, largely a similar impact would be in 2Q. So it's actually an uptick in claims, is it not?
Okay, I'll just explain. So in terms of, there is a trajectory loss ratio has where Q1 is lower, Q2 is higher, then Q3 again lower, and Q4 lower.
Yeah.
So that's a kind of curve. It is following the same curve. It's not that Q2 is lower than Q1. It is more like the trend is lower than last year as we speak in recent months.
Okay. And with regard to the long-term ROE guidance, so now that you've had more of a handle, so are you able to change your guidance, or would you want to just reiterate the long-term guidance?
We will stick to long-term guidance, which is, let's say, FY29 mid to high, teens ROE. We stick to that.
Okay.
Thank you. Our next question comes from the line of Pravesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. The first question is on the GST front, where you mentioned that the commissions you have kind of passed on to the distributors. So you are saying that the ITC impact would not be there at all for Niva Bupa. Is that the fair statement, or you passed on partially and there is some still impact which would come on the books for us? And if so, what would be the quantum of that?
Yeah, thanks, Vesh, for asking this. Yes, we have passed on entirely to the distributor, and as I explained, the distributor has also understood this, that this is ultimately benefiting him because his income is going up. His income is not going down because the volume is going up, ticket size is also going up.
Right. And second is again, again on the loss ratio front, if you adjust for that first quarter kind of one-off, this seems to be much elevated than what we would have expected, right? So is that a benefit? Is there some pockets where the loss ratio have come in higher in some cohorts, or is the group business working against, or I'm talking about the overall loss ratio for the company level. That's what I'm asking. So do you think that the group business or any other place where you've seen some higher loss ratio?
Sure, guys. So in terms of retail, as we explained, it is at same level as last year. Group, of course, is higher because of mix change. We talked about the one large group we have written, which has very, very low expense ratio. So in terms of overall, there is a 1.2% increase, and largely it is coming from group, and group is because of mix change, where group has gone up by 5 percentage points. So in that sense, you're right, this 1.2 is driven by group, and that is again more than offset by a reduction in expense ratio. That's why combined ratio is lower by more than 100 basis points.
While analyzing loss ratios, best split it between the retail and group,
Right.
because they have very different combined ratio profiles because of
Right.
the cost equity. Yeah. The retail, as Vishwanath said, is flat compared to H1 last year, and group has gone up because of certain large corporates. But obviously, there's been a relief on the expense side because of which the combined ratio has come down overall.
And it is fair to assume that the second half, there will be a significant improvement in loss ratio as a group business, or because under IFRS there should not be any change, but on your reported accounts, would that change?
Yeah, under reported in Q4, the loss ratio will be on lower side because that business was written the Q4 last financial year. But that is only reported. IFRS they will not be changed.
IFRS will be steady, and if you go to the we actually have a bridge this time in the investor presentation, because that was also something that many of you had. So this time I put out a bridge explaining the difference in loss ratio, and clearly, as Vishwanath mentioned, by Q4 you should see it swing on the positive in a positive way.
Got it. Thank you.
Thank you. Our next question comes from the line of Shobhit Sharma from HDFC Securities Limited. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, my first question is on your group health business. So what is the strategy on that business now? Because we have seen we had a good growth in last year. First quarter was also good, but in the second quarter we have seen some slowdown. And secondly, coming to the loss ratio, in the first quarterly call you mentioned that we have provided for some 1.5% extra provisioning. So have we taken some reserve releases out of it, or still we are holding on that? Now coming on to the expenses, there is some multifold increase in the business support related expenses, advertisement and publicity related expenses. How to read about it? Have we increased our spending on that? And you mentioned about the growth in the October month. So would you like to give some emphasis on which channels are driving this growth, and what kind of conversion rates and the renewal increase we are going to see because of the GST related impact? And one important thing which I can note from your slide is the share of the direct business has come down by 2.5% on a YOY basis. So are we pushing more onto the more scalable, faster scalable channels, or what's our strategy on that? Yeah, thank you.
So let me take the first one, which was on the group side. As you know, we have been selective. We have been looking at this channel as wherever we find opportunity there. But the combined, we just don't, on the group business, we don't look at the LR, we look at the combined rate. Wherever we feel that the combined is within our side, we do that. And that's where you have seen last quarter, last quarter, we have taken that. This is opportunity there. And this quarter, we have not done that much. So we have been very selective there. On your question on, why is the direct business a little lower this one? This is largely impact of 1/n. If you look at April to April, there is no difference between us, because our strategy remains the same on this side of business. We want to grow our direct, our digital business, in a better way, and we are really emphasizing on how do we grow that. And just to give you a good sense, our growth of business from our direct digital for the first half has been, very good, almost 1.5 time of our average growth of the organization. That's how we've been emphasizing on that. And one more question you had on
October.
On October, so channel by channel split, I would not get into the channel by channel split, but what I will tell you is this impact is in all channels, largely in agency and our digital business and digital partnerships. These are the three channels which have seen the maximum impact of this. Lesser impact in banks, because banks we do a large portion of our business is as considered as a booked under the group RUG rather than a retail platform there. So these are some of the pointers which I wanted to talk about.
Yeah. And Shobit, on other 2 points, loss ratio reserve we have largely released because now its auto adjudication is back. So that's on outstanding. And other question on advertisement, it really depends. It's never smooth across sequential quarter. Last quarter we had a new product launch, so we spent more on advertisement and publicity.
Okay. Just 2 follow-ups. One thing, Ankur, if you can give us some color on the renewal rates. Have you seen renewal rates increasing because one of the peers have highlighted that they have observed some positive traction on that side? And Vishwa, one thing on the loss ratio, you mentioned that we have seen improving trend going the recent months. So is it particularly because of the lower incidence rate which you have been observing, or is it because of the lower average claim sizes? That's it.
Let me first take on the renewal rates. Renewal rates have gone up for us. Specifically, last year to this year, it has gone up by 100 basis points more than that. Just for the month of October, this is about H1. But when I look at just for the month of October, it has definitely gone up much higher than that. Second point is it's not just about the renewal rate. It is also the ticket size, which is the GWP, which is coming from a renewal side. That has further gone up. So both impact put together, we definitely have a big upside coming from on the renewals, largely because of the cut in GST.
Yeah, on loss ratio, actually, it is coming from a mix of both. Average claim size, like inflation is also benign, and incidence rate also we have seen on lower side.
Okay. Thanks and all the best.
Thank you. Our next question comes from the line of Sanket Godha from Avendus Spark. Please go ahead.
Yeah, thank you for the opportunity. Sorry, my question is again on group health. So group health, if you see without 1 by N, for the half it is 13%, and for the quarter it is 6% year-on-year. So naturally it will be lower than typically what you used to report in the past. The slowdown is predominantly visible in corporate plans, that is indemnity plans, or it's more because of the benefit-based products. If you can clarify. And related to that, out of the total group, which you did around 1173 crores in 1H FY26, how much will be affinity-based products, and whether the contribution has gone up or declined compared to last year?
Yeah, I'll talk about the first part. This is largely on the corporate group, whereby, as we said, that our strategy has always been be selective. Wherever you are able to get a good client basis the COR calculation, not the LR, but the overall calculation, then only we are picking that. That's the point there. Let me ask Mr. Krishnan to talk about the second question.
Thank you. In terms of overall group, roughly in the past also we mentioned of 30-odd%, that's overall group. Roughly it's 1/3 in terms of the split, and that broadly maybe I shifted. Broadly it's been the same. Although the growth has slowed down, but given some of the large corporate business that we hope, that's broadly stayed the same from a volume standpoint. Yes.
So Krishnan, the reason I was asking is that if the mix remains broadly the same, then even highly profitable benefit-based plans have grown in those teams.
So that's the reason I was asking this question.
Yeah, we grew our business in those two segments quite rapidly last year as well as last. So the growth is off of fairly, close to 40-50% growth last year and prior year. Sanket would have seen those numbers. So
yeah.
It's double-digit growth on top of a 40-50% growth rate last year. Just to put that in context.
Understood. So maybe sorry to harp on that point, but just wondering whether the we know that the multi-line companies are paying on yen basis on commission, but we moved to one-line strategy. So
that has not impacted us. So okay. That's not had any impact. So I can reconfirm that.
Okay, perfect. And can you quantify your group health loss ratio in IFRS basis for the current half and the previous half?
That's not something we publish.
I think you gave it last time, that 61% was Q FY2026 group health loss ratio, and 68 was retail, and blended it was 66.8. So similar lines if you can give the number will be useful. Yeah.
You are saying overall, not B2B and capital.
Sorry, overall good. Yeah, actually overall good. But
okay. So this hedge fund, we have overall 60.9%, where 60.1 is retail and 60.9. So 60, roughly 68, retail 61 group.
And the last year, same 68 and 60 it was
56. I'm just wrong.
Okay, so 56 down to 61, 68 is flat. That's the way I need to understand it.
Yeah. That's
okay.
And just to remind you, all our ratios include claim settlement costs.
Yeah, I understand that point. Yeah. And this is a fundamental question. IRDA probably allowed, or one of the circulars said that, or master said that your pricing based on claim experience, or based on the customer based on the claim experience can be implemented. A lot of parents have implemented that 30% of the portfolio. We just wanted to understand where we stand and whether the incremental pricing, what we do for the portfolio, whenever we will do it, will we follow this approach consistently?
So Sanket, as we have mentioned in the past as well, the regulations permit favorable claims experience discount. In our case, favorable claims experience and experience basis, for example, if somebody does on an average 10,000 steps daily and records it on our customer app, they become eligible for as high as 30% discount at the time of renewal. So, we continue to implement both of these, when we reprice our products, or when products come up for renewal, as the case may be.
Okay, but we don't have cohort-based pricing. Is it fair to understand? But basically, if it's an same age bracket, one has a little higher loss ratio and some other guy has a little lower loss ratio. So the price hike, despite suppose morbidity is being same, will he experience a differential pricing, or we don't have a cohort-based pricing? It's based on what you said, the suffer points like steps covered and all those things.
And also favorable claims experience discount, right? I mentioned both.
Okay.
We have favorable claims experience discount as well as, other health parameters. So it's not just the hospitalization parameter, but other health parameters to broad base the kind of discounts we give our customers. Essentially, for people who have been healthy, the idea is to encourage them through premium discounts.
And will it be okay to quantify how much % of the portfolio follows this approach of pricing?
We can probably take that offline, Sanket.
Okay, perfect. And the last one, means the retail health growth has been very solid for us compared to the industry being little muted, even on end basis. So just wanted to understand any color you want to give on porting policies and what percentage it contributes to total premium or total GWP in first half.
Broadly, the Open percentage has been stable. In case if anything, it's probably come down. I think in the past we have guided between 20 and 25% is where our open has been, and it's actually it's been range bound in that level only. And the growth has actually, let me sort of address another aspect, right? So we said broadly our retail health has grown 28% for H1 in GWP terms, and I would say 6-7% of that has come from value growth, and the balance has actually come from volume growth. So close to 20% of the growth has been price growth, and the balance has come from ticket size improvement.
Okay. Understood. That's it from my side. Thank you very much for the answer.
Thank you. Our next question comes from the line of Uday with Investec. Please go ahead.
Yeah, thanks for the opportunity. Just one clarification question that the pass-on to distributors, is it implemented for the full quarter or Q3 will still have some impact of GST? Just one question from my side.
The done is effective October 1.
Okay, so Q3 should not have any impact of this, right? It should be a full quarter on GST.
That's correct.
Yeah. Thank you.
Thank you. Our next question comes from the line of Rachna K from SIMPL. Please go ahead.
Hello, am I audible?
Yes, you are.
Yes, you are audible.
Thank you for the opportunity. I had one question. Within our group health insurance portfolio, could you share how the premium mix or share between employer versus SME customers have evolved? Further, if you could provide some perspective on the underlying business economics at a ballpark level of writing employee group health versus SME. What factors make the SME business segment attractive? As you know, we had discussed previously that SME business is an attractive segment within the health business, and how it is different from writing employer business. In addition to this, what has been our approach to become better in SME business in terms of growth and profitability? As this segment, tends to be a bit price sensitive. This is my question.
Actually, employer-employee, SME is also employer-employee technically. So just want to be clear that both are employee-employee. Just depending on the size and number of lives covered, we categorize something as large corporate versus SME. As we have stated in the past, our strategy is to focus on the SME segment, or disproportionately focus on the SME segment. And as I mentioned earlier, we do believe we have a strong value proposition for large corporate, but they are opportunistic, right? It has to come at the right economics around compensation for us to make that. The case in point being that early 2025, we wrote a couple of large multinational companies because they believe very much in a health value proposition, and we were able to write that large business using a health value proposition. So strategically, I just want to clarify that. In terms of the split of the business, I'd say more than 2/3 of our business by volume across the policies comes from SME, probably closer to 75% or even higher. In terms of SME in the company, we actually run almost like a retail business. We source SME business to direct-to-consumer channels. We source it. Many of our bank partners, have large SME lending franchises. We ride off our sizable agency network, and we also ride off the broker network. So it's a multi-channel approach to the SME business, similar to what we do on the retail business. And indeed, we run it like retail, where the conversation to conversion ratio is something that we closely monitor on the SME side. And this is a business that we've been strategically investing in and growing. This business has been growing. If I kind of reconstruct the overall growth, while our overall group business growth has been relatively slower than the retail growth, but the SME growth has been has been close to 50%. Want to add, that gives you a sense of our overall employer-employee strategy, the role of SME, and what engines we're using for both.
Okay, and more on the economics perspective, if you could give a ballpark figure in terms of, combined ratio.
Look, we've spoken about group combined ratios in the past. That's what we've been talking about publicly.
Okay, thank you. That's it.
Thank you. Our next question comes from the line of Vinod Rajamani from Nirmal Bang. Please go ahead.
Hello. Thank you for the opportunity. I don't know whether you may have already addressed this because I joined slightly late. I just wanted to know the split between, in the group segment, the split between employer-employee and benefit. What's the premium split and also the loss ratio split? That's all. Thank you.
Premium split is roughly 1/3 employer-employee and balance, affinity business. Loss ratios we have not been disclosing publicly.
Okay, sir. Thank you.
Thank you. Our next question comes from the line of Raghavesh from JM Financial. Please go ahead.
Hi, thanks for the opportunity. A couple of questions. First, on the claims ratio recovery which you have been discussing, in one period you had mentioned you will take a couple of quarters for this to stabilize. But the commentary suggests it's now stabilized and it is kind of considered as 50 crore number, adjusting for cost growth to be stable there on. Is that a correct understanding?
Yes.
Secondly, how has okay. So, secondly, on the gross commission ratio you have been able to reduce. So, any specifics you would like to give in terms of what channels have contributed to this, or there is a change in mix somewhere that they are missing?
No major movement in channel. It has more to do with the mix change.
So the entire employer-employee is becoming larger. Is that the reason?
Employee, new renewal, all those kind of mix changes.
Okay. And finally, from October, the entire aspect about 1/n and n goes. Or is there something residual which will still coming and we'll have to look at another like growth number? What is progressively is the like-to-like?
Not exactly, because October we started last year. October we started 1/n. So whatever is the premium deferred in those months, it will keep coming. So there will be a cycle. So now we'll keep deferring and it will keep coming from previous months.
But whatever will be reported will be like-to-like.
So last financial year in those months, the previous financial years deferred will not be there, but this financial year these months will have deferred coming from previous financial year. So it will
be slightly higher than what will be there. Okay. Thanks for the answer.
Thank you. Next follow-up question comes from the line of Sanket Godha from Avendus Spark. Please go ahead.
Sorry. Thanks for taking my question again. If you can answer, the commissions is probably 65-20% of 75% of your cost. Just to prepare cost, excluding non-employee cost, we have some GST implications with non-availability. So, yes, we think this will have an implication on profitability in second half onwards, or you think it will be more than compensated by, say, the renewals or the size increase or health measures which is in our features. This one can qualitatively address to me.
Sure. Thank you. So you're right. There will be some cost items, overhead items, where there will be GST and input tax credit will not be available. One is we are looking at each and every item in detail and identifying if we can renegotiate, reduce, etc. on those cost items. Still, there will be some residual, but that will be more than compensated by few items, few you mentioned, and there's another additional item where in terms of claims, the GST on pharmacy or medicines has been reduced. So that's also something which will help us. So overall, we feel that there will not be any negative impact.
Understood. Perfect. And one more thing, means if I look at your ticket size numbers, average ticket size per policy for 1H to 1H and for both agency and overall, there is a kind of 12 to 13% decline, even if I do that math on 1/n without 1/n basis. So any reason you think it has happened, or is it because incrementally distributors are selling less long-term policies and that's getting reflected in the ticket size?
Sanket, there's no reduction. Without 1/n metric, we have given slide number 8. So if you see GWP per policy sold by agent, so it says 25,108, 25,215. So it's marginally high. So probably you are looking at another slide where there is reduction, and that's coming because of 1/n impact, and that will also get addressed from next quarter onwards.
Okay, understood. Sorry, maybe I looked at the wrong slide. You're right. And finally, can you quantify your advance premium sitting in the balance sheet?
Not handy currently, but we disclose that in our IIT financials.
Yeah. So, but it will come with lakhs, so I was asking.
I mean, since it will be available in public domain, we can find out and give you separately.
Okay, not a problem. Thanks. That's it from me. Thank you.
Sure, thank you.
Thank you. Our next follow-up question comes from the line of Shobhit Sharma from HDFC Securities Limited. Please go ahead.
Yeah, hi. Thanks for the follow-up. So firstly, can you help us understand how much of our expenses related to outsourcing expenses constitute total expenses, and what's our plan on that? Because I believe whatever ITC impact would be there on that portion of the expense, if we are able to bring that in-house, we'll be able to offset some of that. And secondly, on the investment agents, and if I look at as compared to March 25 to September 25, the year has been more or less been flat. It is 4-5% only. So what's the reason behind that? And what's our strategy onto the portfolio? Will it always be skewed towards the debt side, and what's our duration of the portfolio? Thank you.
Sure, Shobhit. So first on your question on outsourcing, so we have very small outsourcing vendors where we take help on manpower side from for IT, etc. We are looking at each and every contract and seeing is there value in sourcing that. So in some cases we may do, in some cases we may still continue with outsourcing. But it's not a very major cost item any which ways. On AUM, so this has to do with reinsurance treaty. Last financial year we had reinsurance treaty which was there on where settlement was on annual basis. So in May this year we settled that all voluntary quota share, and this year onwards it's on quarterly settlement. So that's why optically it's looking that AUM has not grown. And the capital contribution was another point, because last year we had 800 crore capital, so that's why there was a sudden jump, and we raised also from private market before that. So those are the only reasons. In terms of bonds, yes, we would like to continue majorly with bond strategy, but we also have close to 6%, which is there in Nifty ETF, EIF, Indate, REIT, etc. So we continue with that, but it's not that we want to ramp up that largely. And second, we are not investing in direct equity. It is only for Nifty ETF.
So what's the duration of the portfolio on the debt portfolio?
Duration would be 1 month. Yeah. I should do the 61 duration. Yeah, 4.5 years. Okay, thank you.
Thank you. Our next question comes from the line of Kushagra Goel from CLSA. Please go ahead.
Hi, sir. Thank you for taking the question. Just one question. So there was earlier we had a news article, right, that the General Insurance Council was.
Your voice is not very clear.
Hi, sir. Is this better?
This is slightly better, but if you're using a speakerphone, may we request you use the handset, please?
Sure. Is it better now?
Yes,
Hello?
please go ahead.
Yeah. So just one question. If there is any update regarding the negotiation which was happening between the insurance industry body as a whole with the hospital in terms of keeping your expenses or the sort of harmonizing the expenses which are being charged. If you can give some update on that, because there was some recent news also on this front.
Yeah, no, I think maybe I'll give a broader update on three big industry initiatives.
Yeah.
One is an awareness campaign. As I updated last time, Niva industry has committed to a sizable spend every year for the next 3 years. I think we had the second burst of that campaign happen during Q2. Second is on the common empanelment initiative. It continues the pace. I think we have close to 3,500 or 4,000 hospitals that have applied under common empanelment. The third, maybe I can request Dr. Doctor to talk about the work that we're doing specifically around standardization, which is also a powerful lever, to control claims cost.
So a lot of focus on standardization of protocols as well. For seven kind of conditions and more than 10-12 diagnosis codes, a standard protocol indication for hospitalization has already been adopted, largely by all players and increasingly by the entire industry for health insurance. This is an initiative where more conditions are being added as we speak, and there is significant not just push but endeavor to standardize these protocols of indication for hospitalization and treatments as well, including position statement that is already underway, led by General Insurance Council on behalf of the industry.
Got it. Thank you.
Including to your question on duration, it is 4.5 years.
Thank you. Our next follow-up question comes from the line of Supratim Datta from Jefferies. Please go ahead.
And thanks again for taking the question. One, just wanted to understand what was the GST impact this quarter? Because I understood that your renegotiated rate started from 1st October. I just wanted to understand what was the impact this quarter. And secondly, I wanted to understand what proportion of the GWP currently comes from narrow network products and how you see that grow over the next 2 to 3 years. Thank you.
GST is not major. 8 crore.
Okay.
Narrow network is still early days. It's probably in the single digit on new sales. But keeping aside that, the first network that we are executing on by the industry, which is now there in 44 cities. I think about 16-17% of our claims in those cities go through the PPN network. The objective is the same, except that one is achieved through the product and the other is achieved through communication, providing superior benefits, working with our distribution, and giving customers better experience than any customer is going to be.
How is the claim experience different in a PPN versus non-PPN? As in the loss ratio?
Loss ratio. Did I get it right? The difference in loss ratio between PPN and non-PPN?
Yeah.
That is not what we publish in the domain.
Look, broadly the price difference on a like-to-like basis is broadly. there's a difference of about 10 to 15% PPM versus a quarterly tertiary care facility.
Yeah, in terms of the average claim cost for microbial treatment, definitely the PPN is, as mentioned, 10 to 15%, or perhaps a little lower in that range. However, you cannot also compute loss ratio at a provider level or a cohort of provider levels, right? Given the calculation of loss ratio is claims upon earned, you can't compute earned for a set of providers, right? So that's not something that is even computable.
Got it. This is good. Okay.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
No, thank you everyone for your patient hearing and your questions. Let me just close by saying that we continue to be super excited about health insurance. Specifically, it is a big focus area for us. And we are continuing our journey of investing and growing the business in a profitable, valuable way. Thank you.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your